Hello, investors. It's Stuart Cruz with Cruz Asset Management's Chart of the Day. Today we are talking about Market Mondays, and let's just talk about the market in general. The S&P 500. I've been asked, is it expensive? We're hitting new highs all the time. So is this market expensive? And in a word, yes, it is. It is expensive. Does that mean it's going to pull back? Well, doesn't mean it's going to pull back today or tomorrow. It might. Short term, it's kind of a crapshoot. Longer term, it definitely follows its earnings. So I do anticipate a market pullback at some degree in 2021. I could see a Santa Claus rally finishing, and as the year starts over in 2021 and we start to reassess, as seemingly all my clients do for their finances, then I think the markets are going to start to take a better look at what's going on, maybe take some capital gains. They're not going to have to pay any interest or any taxes on that capital gains for 15 months after that. So you might see some of that happening and some rebalancing in some accounts. But for right now, the market's expensive. So let's take a look at where we are in the S&P 500 and why I think that. So it's been marching on, and then hitting new highs by definition means it's higher than it was before. Doesn't mean it's more expensive than it was before, but it does feel like it's more expensive always. So here we are at a new high in the S&P 500. And if we look at the PE ratio, which I'm going to put on this same chart, and this is a 10-year chart, and I can see the average PE ratio is down here. We were down in the not quite single digits, but call it 13. And then more recently, we've been trading as up in the low 20s. So when you start getting the low 20s, it starts getting a little expensive. You're thinking about an average PE ratio kind of in the upper teens. But with the low interest rate and the low 10-year treasury, we're getting away with higher, longer-term PE ratios in both the market and in stocks in general, especially growth stocks, where the reason for that is a company's valuation is, in theory, only as much as its discounted future cash flows. So how much can any company produce from this point on until it goes out of business, discounting all those cash flows back? That is, in theory, what the company is worth today. And any movement in the market, any new products, any new adjustments, that's what, in theory, changes the price of the company. So that discounting mechanism, saying how much are those dollars of earnings in the future worth? If the interest rate is low, that discount rate is low, so those future dollars are worth quite a bit more than if the interest rate was high, then those future dollars are almost worthless. So you would value the money today much more greater than you would value the money in the future. But with these low interest rates, you can extend that earnings potential out semi-indefinitely. And if you're anticipating growth, then of course that earnings future growth is much higher than the today's earnings growth. That's why growth companies tend to do better in lower interest rate environments, and why I think when interest rates start moving up, value companies will overtake growth. But let's take a look at the S&P right now. And here we are with a PE ratio of 31. Now that in and of itself is a little alarming, but it's not surprising because when you see the earnings of the S&P 500, they have fallen. So the market tends to look through the earnings into the future to find out what kind of PE we should have. So if we have a drawdown of earnings, so the E in the denominator is down, so that drives the whole ratio up. So that's happened throughout history, and it's not surprising in and of itself. But what does that mean? If we add the future earnings, so I'm going to put this up on the chart here, the forward earnings, so 12-month forward earnings are at 142 for the S&P 500. And if you divide, matter of fact, I'm going to do this math on the fly because I actually don't know what this is. Oh yeah. So I did this a little bit earlier. So if you divide the current level of the S&P 500, 3720 by 142.5, you get a PE ratio of 26. Now, if our long-term average has been 20, and we are a year from now hoping to get into a PE of 26, that looks expensive to me. So either earnings have to crush it, or interest rates have to stay low indefinitely and we just have to stay expensive, or there's going to be a pullback. I don't know which will happen. The markets have proven to be able to stay expensive for much longer than we thought. Like, for instance, during the irrational exuberance phrase of Alan Greenspan, when he uttered those words, the stock market doubled from that point over the next 2.5 years. So it stayed expensive for 2.5 years longer than what Alan Greenspan thought was already an irrationally exuberant, expensive market. So I can't tell you it's going to sell off, but are we expensive? Yes. Does that say for the long-term average for the S&P 500, the 5-year returns, they should be kind of dampened. So that's where we're at. So don't get overly excited. Maybe you have some money on the sidelines and some dry powder, as they say, to invest if and when we do get a pullback. It will come. I just don't know if it'll come in a month or in a year, in 3 years from now. Okay? So this is Stuart Cruz with Market Mondays, trying to help you and our clients live your life with the odds in your favor.